Hello and welcome to Commodity Champions, your weekly dose of what's brewing in the commodity space. I'm Manisha Gupta. Well, let's look into who has performed this week, and that definitely is the cryptocurrencies. As has been the case so far this year, Bitcoin was on a rally on its own, hitting new highs every day this week and powering into $17,000 per Bitcoin level. It has doubled in the last 2 weeks and has gained 1,600% in this year. But if you think that this rally might make some people cautious, then you clearly are mistaken. The exchanges are reporting record traffic. Another important development for the Bitcoin space is that Chicago Mercantile Exchange and Chicago Options Board Exchange have announced that they are going to launch Bitcoin futures in this month itself. Actually, the dates are 10th December and 18th December on that. To speak about on what can be expected, though, in the commodities space, let's move on to that, because it has been cryptocurrencies that has been gaining up, but there's plenty action happening in the commodity markets as well. If you take a look at the gold and silver prices, well, we have seen a decline come in for those. The metal prices also are closing this week in the negative. And if you look at the crude oil prices, well, that's down nearly 2% as well. So everything when it comes to commodities was trading exactly opposite to what cryptocurrencies were doing. We are closing this week on the negative for most of those sectors. Well, to discuss more about that, we are now joined by Sanjeev Agarwal of Gitanjali, David Lennox of Fat Profits. We also have with us Jonathan Barratt, who is CIO, Ayers Alliance. Gentlemen, hi, thank you so much for joining us. Jonathan, I would want to start with you really. What a year it has been when it comes to the crude oil prices. It has been on quite a bit of a run. Actually, if you look at the prices from the month of June, it is up nearly 40%. The last couple of weeks actually haven't performed so well. But what is your sense? How would you look at 2017 as a whole? Has it really been about the OPEC cuts and the strong demand? And also, what is your sense on the U.S. output going forward?
Well, Manisha, I think it's been an interesting year for oil, there's no doubt about it. But I think there's been a combination of demand from the economy starting to pick up, particularly in the US, and of course OPEC and Russia coming together and sort of putting those supply cuts in. So I think it's more of a combination of the two, which are causing prices to basically stay in a range, but at the moment stay at the top end of the range.
So what's your sense as we get into 2018? What kind of weightage would you want to give to the crude oil prices from here on, and what cues would you want to watch?
Well, I think at the moment I sort of feel that because we're holding these levels, and I certainly see there's the prospects of more demand into 2018 coming. And I think whilst we've got the cuts in play, as we know, Russia is looking for an angle to get out if they need to, then I can only see that the price trend will be for prices to continue to firm from here. And when I look at the main things that I'm going to focus on, obviously it's going to be the amount of oil shale that comes out, the Baker Hughes rig count, see if that steadies off, but also signs from OPEC and Russia to say in their willingness actually to stop the supply cuts. So I guess once again, it's the same drivers we've been talking about in 2017, but more so into 2018, I see demand will be more of a feature, and whilst we have those cuts, prices will go higher.
So Jonathan, is $60 per barrel a new norm, or are there risks on the downside?
Look, I don't think there's a lot of risks on the downside. I think that, it's steady as she go when you look at all the economics. When you look at the metrics, they're all suggesting the demand is still there. And I guess when you look at GDPs around the world, it seems to provide a very healthy outlook for the commodity. So when I look at the prices, I think that 60 is a new norm. In fact, I think you'll probably find the prices, those norms will pick up a little bit. And I wouldn't be not surprised to see Brent through that 65-70 Q1, Q2 next year.
David, let's get you in the conversation as well. How are you looking at the crude oil prices? Because they have actually held on, and as Jonathan is pointing out, that we are looking at more upsides from here on than the downside in the markets, really. What is your sense? What are you watching, and what ranges are you looking at?
Yeah, look, I guess if you have a look at the oil markets, the reasons for the market holding true at the moment primarily is on the back of OPEC, the fact that we now know that the ceiling of 32.5 million barrels is pushed out to the end of 2018. OPEC and its allies have been quite compliant over the last, since the agreement was put in place, they've been quite compliant with maintaining that agreement. So the markets are now quite comfortable, which has been quite a shift from views of the past, are quite comfortable that OPEC will continue to maintain that ceiling throughout 2018. If that's the case, then, and we do see in 2018 a more robust demand outlook, certainly from the US, and probably coming from Europe as well now, and being backed by continued strength in China, then that does bode well for demand. With that, we would expect to see higher crude prices in 2018. WTI, we're probably looking at a range between $70 and $80 for next year, and for Brent, you'd just have to add $3 to each of those WTI prices. The only headwind we can see, unfortunately, has been one that we've faced all through 2017. That's higher domestic US production, up about 1 million barrels from the start of 2016. And with companies looking at a higher oil price in 2018, US companies especially, lower cost of production, then we can probably see domestic production in the US breaching 10 million barrels. And that's really going to stop us from saying the oil price could perhaps go to $90 or $100 next year.
All right, so both of you are quite bullish on the crude oil prices. 60, 70 and even beyond is what we can expect on prices. So Jonathan, what would that mean then for the consumer countries like India? What should we be watching out for?
Look, I think at the moment it's sort of, because if we take what we learned in 2017, that prices were in a range, then I think prices will remain in that range. I think that not until we get an abnormal would I then start to move in and start to hedge. You know, and I think given the dynamics at play that we've seen this year, I think a lot of that will happen next year. So I think the ratcheting the pricing will be marginally higher, but I don't think it'll be too much. So I think from a consumer nation like India, I don't think you can really do too much. As long as it stays within that $10 to $15 range, we're okay. Obviously, if we get something occur and we get runaway prices, that's a different story. But given the state of play today and trying to forecast into 2018, I see this play remaining the same, but prices marginally higher.
All right, so that's what we are concluding on crude oil prices, that we are looking at further gains into 2018 as we go forward from here. Gentlemen, let's start talking about the metal space as well. And David would want to start on that with you. A couple of them are holding strong, like copper and zinc, but the others have seen the year-end profit taking already begin. With the kind of decline that we are seeing in prices, what opportunities would you see on buying from here?
Look, certainly going into the end of this year, Manisha, we do think that if you have a look at the reactions that we're seeing in the commodity prices now, it's got a lot to do with the direction of the US dollar, firstly, and that's been on a positive trend over the last trading weeks, as you suggested just a few moments ago. So overall, we would suggest that the volatility will continue as we go into the end of 2017, and that is because markets are getting a little bit concerned about the growth aspects of 2018, because we have had such a strong run up to date in commodity prices. So when you take that into account, the markets are just probably at this point in time just taking a little bit of a breath and pulling back on some of those prices. We do think that in 2018, the fundamentals still remain very much in place for the commodity prices to run higher. And that is on the back of, we believe, like we've said on many occasions regarding zinc, that there will be perhaps more supply constrained positions starting to appear, possibly in the likes of copper and potentially nickel next year, as demand continues to remain quite robust and supply is curtailed. So take the opportunity, we think, with the weaker prices that we're seeing at the moment, to come into the commodities, probably across the broader commodity setting, and then expect to see, we believe, stronger prices in 2018.
David, so you've laid out all the strong fundamentals, the reason that the metal prices will gain from here on as well. But any favorites that you're picking in right now? Because copper and zinc is something that most experts really like at these levels.
Look, certainly we're expecting, as I suggested, to see some volatility. But again, going into 2018, it is going to be the market looking at the demand side of the equation a little more than perhaps we have over the course of the last couple of years, and seeing that that demand is going to continue to expand. And that's really going to drive, we believe, investors back into the commodity sector. Zinc, we've talked about on prior occasions, it's already in deficit demand. That price has come off its peak, yes, but it has remained relatively stable below that peak, and we do think that new peaks will challenge higher peaks in 2018. Copper will probably, we think, go the same way in terms of being in supply constrained or supply deficit positions, and that should drive the copper price. We've seen it up over the $3.10 region on a number of occasions this year, but we could perhaps see it beyond that through 2018.
All right, so newer highs in case of zinc prices, but copper prices also will continue to run up. So, Jonathan, getting you in that conversation as well, whether it has been metal prices, metal stocks, metal ETFs, everything has done well. Of course, the last 1 month has gone in for year-end profit taking, but the fundamentals, as David put out, are very, very strong. What are your favorite picks here? Is it also going to be copper, zinc, or are you including nickel here as well?
Look, when I look through the whole complex, I remain bullish, particularly bullish copper, because I really like copper, the story behind copper, and of course I like nickel as well. The other base metals I can sort of give and take, and I think they'll be steady, if not come under pressure. But I guess over the last week, 2 weeks, we've seen quite a large sell-off in the copper markets, but I think that's what it is, just a sell-off. When I look at the structure of the market, it's a reasonably good contango. The forecast for a supply deficit remain there. We still have labour unrest in Central America. That hasn't been solved. So when you look at the supply-demand picture, I think it still remains pretty good for prices to remain high. So I'm just looking at the moment for copper to come back, also nickel to come back as well. And I think that's a good play moving into Q1, Q2, 2018.
All right, so crude prices are a buy, and in the metal space, our experts are laying out copper, nickel and zinc as their top contenders for 2018 on a very, very bullish territory here. But with that, we'll go for a short break. When we come back, we'll also get you the outlook for gold and silver prices going forward into 2018.